Hello, everyone. Thank you for joining the podcast. Today's guest is Jeremy Greshin. Jeremy is a private corporate and real estate attorney turned real estate investor. Jeremy, welcome to the podcast.
Oh, thanks for having me, Samarth. Very excited to chat with you today.
Thank you for coming on. Let's get started. So, Jeremy, can we start off with a little bit of your background and what you do and how you got involved in the real estate investing space?
Sure. Pleased to do it. I started out my career as a corporate and real estate attorney until around 1990 at two large law firms in Hartford, Connecticut. And then I left the law to do business development work for clients, help them enter markets, Europe, Asia, and South America. And then I transitioned into working in real estate in around 2015, started my own company with two partners in 2017. We were focused on multifamily apartment buildings at that point. And then I bought them out in 2022 and have been focusing on self-storage investing since then.
That's awesome, Jeremy. That's a lot of experience. Can you tell us a little bit about what your current company, Scaffold Partner, is and what does it do?
Sure, absolutely. Scaffold Partners works with individuals and family offices interested in investing in real estate. So we provide carefully vetted self-storage investment opportunities to our clients to help them earn consistent returns and diversify their investment portfolios out of the stock market.
Thank you for that. So my next question to you is, you said you have a legal background. How does that help you with your approach to real estate investing and how you structure your deals at your current company? Can you talk a
Sure,
little bit more about that?
absolutely. I learned as a lawyer the importance of representing your client's best interests and always having your clients first. And in real estate, that means being incredibly investor focused and looking at deals from the investor's point of view, and also investing personally with our investors to have skin in the game. So if the investors don't have the potential to make money in the deal, if we execute the business plan, then we don't do the deal. We turn down the vast majority of the deals that we look at because we want to protect our investors' downside while providing for a strong upside. And we want to be responsible stewards for our investors' funds.
That's great, Jeremy. My next question to you is, what are some of the benefits of real estate investing offers to passive investors who want to deploy some of their capital in commercial real estate? Can you talk a little bit more about that?
Yes, we tell investors generally that there are at least three advantages of or differences, let's say, between real estate investing and the stock market. So real estate can be a reliable hedge against inflation because as prices go up, so do the rents. You can raise the rents at a self-storage facility or a multifamily property to stay in line with that. So your purchasing power is preserved in that situation. The second difference is stocks and real estate can offer steady income and distributions and so on, but the tax advantages to real estate are really superior. But accelerated depreciation, cost segregation studies, and 1031 exchanges are the types of things that you can do in real estate that you can't do in the stock market. And then the last one is real estate offers some diversification from the stock and bond markets. It's not subject to the same market volatility. Stock market can go up, companies can have problems and be in the headlines and so on. And if the equity markets are down, but a particular real estate asset that you own is fully leased, you're still going to be making money that way. So real estate is good that way also. We suggest to our investor clients that they set aside about 15% of their portfolio for real estate investing to sort of be away from the stock market for that part of their portfolio.
For those in the audience or someone listening that is fairly new to the syndication space, can you talk a little bit about what is real estate syndication, how it works?
Yeah, absolutely. So real estate syndication basically is a group of investors that are going to pool funds to raise money to purchase commercial real estate or to build a property. It's just that basic. And typically the sponsor or the general partners are going to work with high net worth individuals, family offices who are going to put in or are going to basically put in the money to invest passively as the limited partners in the deal. And then the general partners will manage the deal and the limited partners will invest their funds with the intention of either getting annual distributions if it's cash flowing property, or a share of the profits, or at least the share of the profits upon the sale. And real estate syndications can also be called private placements because while there are laws governing them under the SEC, they are not public investments.
Meaning they're not publicly traded placements, as they call it. They're private.
Yes, they are private to certain investors, and we can get into that.
Okay. So let's say someone is looking into investing in a syndication for the first time. What are some of the requirements for someone who is looking into it? Do they have to be qualified? What are some of the requirements that SEC has put in to safeguard the investors?
Great question. So typically you have to be what's called an accredited investor, which is a buzzword, accredited investor. And then there's various ways to become or to be accredited. For an individual, you have to have an annual income of $200,000 a year or $300,000 if you're married. That's one possible way. A second way is you would have a net worth excluding your primary residence, not your home, but your net worth excluding your residence of $1 million. Those are the two big ones for individuals. But people can invest through IRAs, through trusts, through corporations, jointly with somebody else as well. If you're an experienced investor or a sophisticated investor, and you're willing to represent that in the offering documents, that will work as well for you, even if you don't meet the accredited investor credentials or qualifications.
Got it. There is a way for both accredited and unaccredited investors to source these types of deals or invest in
Yes,
these.
yes, it just depends on how the documents are written, which exemptions the attorneys are putting in there to allow for unaccredited investors to participate.
Let's say that someone is qualified and interested in investing in a syndicated investment. What are some of the tax advantages that they could take benefit of?
Sure. While there are deductions for property taxes and insurance, mortgage, and so on, at the corporate level, there are also three major tax benefits for individuals that are investing in real estate. The first one is bonus depreciation. And with the recent tax legislation or the recent budget legislation that came through, bonus depreciation is now up to 100% again. And that allows the sponsor to front load 100% of the depreciation immediately for improvements like fencing or parking lots, so that you get to maximize your expense deductions. Some of that depreciation does have to be recaptured upon sale, but you do have the losses up front. The second tax advantage is what's called cost segregation studies. They're done by cost segregation companies, and they allow sponsors to accelerate depreciation by separating non-structural personal assets, if you like. Let's say windows and doors, which have a shorter lifespan than other things, they can be depreciated upfront. So one of the properties we're working on, Scaffold invested $100,000, and we ended up with a 60% of that amount was shown as losses due to the bonus depreciation and cost segregation studies that were done. So that's significant, on your tax return. And then the last one is called like-kind exchanges, or 1031s, after the tax code provision, section 1031. And they allow investors to defer paying their capital gains taxes on the sale of the property if they invest the proceeds in another property of equal or greater value. So you would be looking for another property, you would put your money into that other property, and then you would defer your tax gains. And you could continue to do that, indefinitely. These are complicated things, though, and we want you to, basically talk to an expert, your tax advisors, before you get into them. But these are clearly some great advantages of investing in commercial real estate.
That's very detailed. That some of the tax advantages that you mentioned, they're very complex strategies too. And the last point that you made, to talk to your tax advisor about these things. So that's one of the really important points is your personal situation might vary.
Exactly.
So always talk to your real estate advisor, tax advisor, legal advisor before you're looking into investing in a syndication or real estate in general.
That's a good point, Samarth. I agree.
All right, let's jump into the self-storage discussion. Jeremy, I know you're pretty heavily interested or specialized in self-storage now. it was a strategic decision for you to go into specifically self-storage asset class. What initially drew you to the asset class? What are some of the compelling characteristics of the asset class? And then why is it such an attractive focus for you, your company, and your investors? Can you talk a little bit more about that?
Absolutely. With the real estate investment trusts, the REITs, self storage has basically done better than every other real estate class. You think about retail or residential or healthcare, industrial, and the stock market. So, and that's over the past 30 years. So, average annual returns over that period of time are almost 17% for self storage, which again has outperformed all the others. For operationally, we like self storage because it's just a very simple asset class. It has the lowest operational costs, personnel, maintenance, repairs, minimal capital expenditures, and lower utility costs. Because if you think about it, it's we don't have in this asset class, you don't have plumbing, you don't have a lot of people that are there. So it's an easier class to work with. There's easy management because once you show the unit, you rent the unit. When people leave, you sweep it out and then you rent it again. So the turnover costs for these things are very low. We have low liability because there's no tenants on site, so you don't have to worry about those kind of insurance issues. And it has what's called the lowest WALT. WALT is a term that stands for weighted average lease term. And what that basically means is we can be very sensitive to pricing conditions because our lease terms are so short. So if someone is leaving, we can quickly bump the rates to get them closer to where they should be compared to, let's say, a retail lease, which is very long and the people are locked into that rate for a long period of time. So we can make adjustments more rapidly. And then last, when it comes to evictions, evictions in multifamily or in retail can be very complicated. But here, basically, in most states, if people don't pay their rent after 90 days, we can basically go in and auction off what's in there, depending on what the states allow, and then re-rent the property. So it's, again, a much simpler operational asset class.
That's great, Jeremy. So my next question is, many passive investors consider different asset classes, right? If it's either multifamily, there's self-storage, there's mobile home parks, there are a lot of different asset classes. From an investment perspective, what are some of the fundamental differences in upfront investment, ongoing maintenance, operational demands between, let's say, multifamily and self-storage, just because multifamily has been a lot popular lately along with self-storage. So what are some of the key differences between the two operationally and investment perspective?
So multifamily properties, as you can imagine, are more expensive because if you think about it, you got an apartment versus a storage locker. So generally, multifamily properties are going to be a bit more expensive. And they're also going to be more expensive and time consuming to maintain because you could have plumbing issues, you could have swimming pools, you have appliances, you might be upgrading the interiors. Maybe you're putting in flooring or windows or kitchens. You're going to have tenant problems. So all of those things are a little bit different on the multifamily side versus on the storage side. While you may have some improvements to make, you're really dealing with doors and hallways in many storage properties. So it's a little bit simpler to manage. Operationally, that's going to mean apartments are going to require a larger staff and higher overhead. Some storage facilities can be managed remotely or operated remotely nowadays with technology. Leases for apartments tend to be a little bit longer, as you can imagine, whereas short-term leases for storage can be month to month. If it's a student that's in there, just wants something during the summer, for example. And another interesting difference is multifamily properties want to be 100% occupied, but self-storage facilities would rather be, let's say, 93% or so occupied so that they can make rate adjustments with new tenants. So as new tenants come in, you can be very responsive to market conditions and your prices aren't not going to be locked in. So you can continue to raise them if the market allows. Mm-hmm. But given housing shortages nationally and the high interest rate environment, people are renting a lot of multifamily right now because they can't afford to buy. So that bodes well for the multifamily sector in general. And it also works well for self-storage as people have less space, they have to store their things. So we've had investors that have done 6 multifamily deals and done extremely well. And we have investors in self-storage as well.
And when we met earlier, we had discussed a little bit about like how there are a lot of different use cases for self-storage as well. One of them was e-commerce businesses using self-storage space as a way to store their inventory or running a business out of a self-storage unit. And I know there are a lot of different types of self-storage properties. There are climate controlled properties and there are outdoor self-storage properties. So can you talk a little bit about what type of self-storage properties are there?
Sure. As you alluded, there are climate control and non-climate control is one way to divide them up. So the climate control ones, think about, in a large city or a suburban area, it's a multi-story property, and that's where you're going to store perhaps things that are you don't want ruined by humidity or cold. So maybe some of your valuables you might want to put there, clothing or furniture or records that are important to you, you might put in a climate control facility, and they're going to be, of course, more expensive. The non-climate control ones, sometimes called drive up because people literally can drive right up to them, are the kind of thing you might see on the side of the road in a more rural or secondary markets where basically people drive up to the door, they roll up and they want to put maybe their Christmas ornaments in there or their garden supplies or something that isn't going to be affected nearly as much by climate. So the higher end properties tend to be climate controlled. The lower end properties tend to be non-climate controlled because people don't need to pay as much money for, again, garden supplies or things like that. There's also another way to look at self-storage properties in terms of, as an investor, I guess you could say there's three types. One is ground up construction, which carries with it a little bit more risk because you've got construction risk. And today with tariffs and with steel prices and so on, ground up construction, while it can be the most lucrative, also there are risks with delays and zoning and that type of thing. So that is frequently today, a lot of climate control storage is going that way of ground up. The middle ground for this is the conversion. So we have a Kmart that we converted. It was a vacant Kmart building in South Carolina, and it was just sitting in the middle of a nice retail area, vacant. And we spoke to the town, and we were able to turn that into, in 9 months, we turned it into a state-of-the-art self-storage facility because it had good plumbing and heating and electric in it that we could use, but it still carried some of the risk of a full lease up like a ground up. And then the least risky is what we call the value add. And that's a property that exists already. And maybe it's run by, let's say, a mom and a pop operation, and the rents are low. They haven't done repairs in quite a while, or they're not using technology at all, like SEO or AI or anything that's to enhance the operations of the property. And people would come in and then buy that value add property and then hold on to it for a while and then sell it.
Interesting. Yeah, there's a lot of opportunity for growth, sounds like, with value add self-storage,
Yes.
where you can come in and increase the value of the property by adding features that weren't there before.
That's where we tend to want to play ourselves. We like playing in the value add area where you can take a B or a C asset and do a business plan to it and then sell it afterwards. That's our personal strategy. But there are many others. There's plenty of people that want to buy a Class A property and they want to hold on to it for a while and basically what we say, clip a coupon, where they're going to be getting the ongoing rents, it's residual income, and they don't need to do anything because it's a Class A property and it's already fully leased. So that's another strategy.
Got it. Got it. Moving on to my next question is self-storage. From my research, sounds like it's a recession resilient asset class. How has this asset class performed historically, and what are some of the demand drivers that make it recession resistant? Can you talk a bit about that?
Self-storage is unique, we think, among the real estate asset classes because it works well in a good economy, because that's when people want to buy the next house or they want to buy more stuff and they need a place to put their stuff. And then it works well in a bad economy when people need to downsize or maybe move home. So as long as there's motion, generally for self-storage, that's working well. We say that there are the 4 Ds in self-storage. There's death, divorce, downsizing, and dislocation. And each of those contributes to motion in the self-storage universe that works for us. Where we have a difficulty was the economy that we're coming out of right now, because there was, for a period of time, not much motion at all. People could, with mortgages of, let's say, 2 or 3%, couldn't buy the next house because they were having to pay 6 or 7%. So they weren't going to move. People were also fully employed, so they didn't need to downsize either. So there wasn't much motion going on for a period of time. We see that slowly changing now as storage rents have stabilized nationally. In fact, we're up 1.3% year over year, and occupancy is also stabilizing.
That's really great, Jeremy. This is one of the asset classes that I had no idea about prior to speaking with you. I've always been interested in multifamily investing, so this is very helpful to learn about self-storage. All right. So, Jeremy, my next question is, let's talk about the syndication. Can you talk about a typical life cycle of a real estate syndication from, you know, all the way from the beginning of identifying a market, identifying a property, or finding a property to an eventual exit? Can you talk about some of the key phases involved and what are the sponsor's primary responsibility during each of these stages?
Assuming we already have a property in place, we're going to underwrite the deal to see if it's doable. That's the first thing we're going to do. And when we say doable, we mean from the perspective of the investors, are they going to be able to make money and so on? And if we like the deal and we win it, then we're going to start our due diligence on the property. We'll enter a letter of intent with the owner, and we'll start the due diligence. We'll start to arrange the financing, and we'll prepare a business plan. And then we'll decide on our third-party property manager. And then we're going to go to a PSA, or a purchase and sale agreement, which locks us in, and we put some money up front that says during the due diligence period, they can hold the money. And assuming we go forward, that goes as a deposit to the eventual sale. When we arrange financing, we're going to explore debt options in the market. You know, what kind of banks can we talk to and so on. And then we're going to raise the equity, talk to our passive investors with an offering memorandum. And then we'll work with the attorneys to prepare the closing documents. After we close and we own the property, we're going to work with the property manager to execute the business plan that we prepared. So we're going to be doing like setting up a portal to monitor the incoming rents, verifying expenses are online against the plan, and so on. If there's any capital expenditures, if we set aside some money to repair a roof, let's say, which is what we're doing in the deal we're doing now, we're going to make sure that we get the roof construction underway. And we'll be meeting at least monthly with the property manager, and they typically have an online portal that we can look at to check out the rents. And then we'll go on site from time to time. And then when the time is right, when we've executed the business plan and we think we can maximize the investor's returns, we'll prepare the property for sale and we will sell it.
Jeremy, thank you for walking us through that. So before you even start looking at properties, the first step of the process is to look at a market or to find a market.
Right.
So what are some of the demographic related data or economic indicators you're looking at before you identify a specific market?
Sure. So before we obviously put in an offer and so on, we're going to be doing a lot of underwriting and due diligence. And as part of that, we'll use a variety of software programs and research to look at the demographic information around the market and around the property, such as the amount of storage in the area and new developments in the area. We'll look at what type of competition look like, what unit sizes do they have versus does this property have. And then we'll look at just basically straight demographic information. So average home prices, it's important what percentage of the people rent versus own, population, and is the population growing? What does the housing market look like there? How many permits are approved for future development? What are household income levels look like? Traffic past the site, vehicles per day, how many cars are going by the site? That's important. And then nearby multifamily and retail locations that would help us in terms of getting our tenants. And then, of course, we're going to also go visit the site and we'll speak to the competitors. Maybe we'll secret shop them. We'll look at the apartment complexes in the area to see how close they are. We'll talk to the town officials if we think we need to, all those types of things as part of our due diligence process.
Mhm. And when we were speaking prior, you mentioned something about alternative use for the property as well, where someone with a boat may want to park on the property as well. Is that something you look for, or you look for a lake nearby?
If the property has, for example, a lot of RVs and boats on it, or has the potential with vacant land, we can look to see how close this property is to a body of water where people would be able to roll their boat out of our place or their RV, go on vacation because they want to do that, or near to lakes so they can go boating for the day. So properties that do have RV and boat parking, we do need to consider that as part of the due diligence. You're right.
Uh, So we spoke about selecting your market. Let's say you have a perfect market. What are some of the next steps of sourcing the properties? I know a lot of
Sure.
relationships need to be built with the local deal providers like real estate brokers, realtors, or someone direct to the property. That's a lot of work that you need to put in to build those relationships. So are you building those relationships directly in the market right now, or are you directly going to the sellers through direct to seller campaigns? How are you sourcing these deals?
Sure. So we do a combination of working with our sponsor partners to identify deals and then sourcing them ourselves. So we'll use brokers in those markets. We'll use online platforms that exist, such as Crexy, for example, to pick a name, and then word of mouth. And most good sponsors have a network that they're going to rely on, as we do. And once you do a deal successfully with a broker, they're typically going to think about you again for another deal, and you develop relationships that way. There are some people in the market that do direct mailings to owners. We don't choose to do that. That method it works, but it's very time consuming and low percentage, kind of like cold calling. But
Mhm.
you can make phone calls and you can do direct mailings, and sometimes you find properties that are off market, so you don't need to pay a broker. But we tend not to do it that way. It requires you to be focused on a particular geography and to get very lucky. So we tend to not do that.
Yeah, that's a really good point, Jeremy. Broker relationships can come in really handy in providing a great deal source. So there's no one strategy that works, but it seems like building broker relationship so far has worked out for you. Can you talk a little bit about the next step? Let's say you have a deal in your inbox from a broker, right? So what do you do next? What are some of the underwriting assumptions and, about the revenues, the expenses, the growth, the stress tests? What are some of the assumptions that you put in once you get a deal in your inbox? What do you do next?
Sure. We'll take some of the information that the seller provides us, and you have to always take that with a grain of salt. You need to confirm it and verify it yourselves, but you can sometimes start with that as a point of departure anyway. And then we're going to model the deal really very, very carefully based on our own market analysis. We're going to do our own thorough analysis of the market. Where do we think rents are today in that market? And then will the market be able to sustain some rental increases and some increasing expenses if we want to execute our value add business plan, which is what we're going to be trying to do. So, in one of the deals that we're looking at, that we're doing actually right now, our analysis is showing us that we can boost rent 6% annually and expect in turn expenses will go up 3% annually. The market isn't growing, but there's all the local storage facilities are full in the area. And based on our analysis, we think that will work. We're going to stress test that by assuming we don't meet our revenue goals or our expenses suddenly go up or we get a big tax bill or something like that. So we're always going to stress test it. But those are the underwriting assumptions we look at. And I should tell passive investors that a lot of times you can throw these models into Chat GPT and they will come up with questions for you, or they'll even help you design models these days that can answer a lot of these questions and verify that your information makes sense.
That's a really great point. That's something I've done myself is put it in a deal package into ChatGPT and have a specific list of questions that I have asked the prompt to basically
Right.
ask a specific list of questions to go through the PowerPoint and answer these questions for me. How does it make sense for me as a passive investor to invest? What are some of the questions I should be asking? So that's a really good point there. When you're underwriting, how has the current interest rate environment affected sort of the assumptions that go in and the returns that the models are projecting?
That's sort of been the Achilles heel of real estate, or particularly self storage. It's been Interest rates have just been really, really tough over the past 18 months or so. And they put a damper on a lot of real estate deal flow. People haven't been able to move homes because many of them are sitting in 2 and 3% mortgage houses, and they don't see a reason to refinance at 6 or 7%. So that lack of motion has hurt the self storage industry. And again, as I alluded to earlier, I think we're coming out of that. But we've also, from the owner's point of view, from the sponsor's point of view, we've underwritten deals over the past 2 years. And when we account for the banking financing rates, they just don't pencil out. We find that we can't meet the seller's asking price at 6% interest. We could at 2 or 3%, but when we're at 6 and 7%, suddenly we can't meet the seller's selling price to make the investment worthwhile. And so there has been a disconnect between sellers and buyer expectations. The sellers tended to be ignoring the rising interest rates, and the buyers are having to live with those rates. But with interest rates high, it has made it much more challenging for real estate in general and self storage in particular.
Are you seeing a lot of seller financing or seller carry going into the projections or being offered by the sellers to make the deals work?
Yes, and that's been one of the things that we look at. So when we try to do these negotiations with sellers, what we try to do is we come up with what we think is the price that we can afford to pay. What we think the deal is worth, and to make it work. And then we try to work with the seller to help them figure out how they can get what they need. So sometimes seller financing is a great tool. So in this deal that we're doing now, the seller is going to be doing $800,000 of seller financing. He's going to be doing it at 6%, and it's interest only. So that's going to allow us to have a rate that's below what the banks are offering. It's going to allow us not to have any personal recourse against ourselves for that. It's just an easier workaround for us, and it can get the seller to the price that he needs while also getting us better financial terms. So we're trying to be flexible. There's lots of other tools that buyers can use to try to work with sellers if they're willing to, in terms of making a deal work. But I should say that a lot of times, if the seller and the buyer can't agree on terms, the best thing to do is to walk away. And we've walked away from a lot of deals where the seller just can't be flexible enough, and we can't afford to reach their price and make money for our investors.
All right, Jeremy, moving on to the next question. Once a property is acquired, what is your business plan? What are some of the ways you're increasing the rents, minimizing the expenses? Can you talk about the business plan from the day you purchase the property all the way to exit, let's say next couple of years from now?
Sure. So business plans are going to vary depending on the needs of the property, right? So, if you've got a recently built Class A property that's fully leased and it's got professional management, you may not have a lot of improvements to make to it. Basically, you're just going to be clipping a coupon. And we generally don't buy those properties, but the business plan is to keep things steady as she goes in those type of properties, to make sure you're watching the rents and so on. In the older Class B or C properties where we tend to get more involved, you do have to, let's say it's a property owned by the same person for a while, and there's a
Mhm.
real value add story there. It may require a lot of physical improvements. So it might need roofs or gates or security systems. And in multifamily, you might have to replace all of the appliances, pave the driveways, and so on. In self storage, we want to establish an online presence with a rental platform, with SEO, with social media. So there's a lot of those upgrades you can make that typically a mom and pop wouldn't have in place. And
Mhm.
then we're going to be studying the facilities rents and compare them to what the competition has and making adjustments accordingly. Rent increases are typically going to go out in self storage depending on the property and the market and the tenant base, but you want to make sure that you're putting those tenant increases in place. A lot of times with mom and pop operators, they don't have tenant insurance in place. And so that's a revenue source that we're going to want to take advantage of. And we will put that in place. Again, we'll do a more aggressive marketing campaign than most mom and pop operators have, with social media. And we'll also even use physical signage. We want to get to know the community personally by involving ourselves there, but we also want to put up good signage so people can see who we are. And then we're going to be reviewing the property's expenses when we underwrite so that there's no surprises. The big expenses in self-storage tend to be payroll, insurance, and taxes. And we want to make sure that we'll talk to the insurance broker and we can talk about that. And then we're going to, check to what we think the taxes are going to be and what we think the property manager's payroll is going to be. So we have to make sure we know those things and they're in place before we get going.
Right. And speaking about insurance costs, recently there have been a lot of increases in insurance premiums almost unexpectedly. Can you talk about how is that affecting your operations or your underwriting strategies?
Sure. I mean, insurance costs are impacting all real estate types. We've had a lot of climate change issues, and we tend to want to stay away from high profile coastal areas like, for example, LA that had the horrible fires and the Santa Ana winds. And then areas in Florida that are more prone to hurricanes. We try to stay away from those areas because the insurance costs can become prohibitive. And even if your property in California isn't affected by those things, if it's near the bad area, then you're going to get your rates bumped anyway. So we tend to want to stay away from that. And we talk to the property insurance broker for the property that we're working on to see what they can do. And then we underwrite for increases in insurance premiums and shop aggressively for insurance when we're in the market.
Got it. And then how about your relationship or just local government regulations or zoning requirements? How does that come into play when you're looking at a potential investment?
Sure. So local government regulations and zoning and permitting are going to vary from community to community. So there's no one way that each community acts. Some communities, as you can imagine, are more welcoming than others are, and some are more, treat self-storage well and others don't. Some communities now are banning self-storage entirely. Just by way of an example, the nature of signage allowed on a property. Some operators have to understand what they can and they can't do. Some towns will allow you to put a big sign up. Others want small, discreet signs. So you have to know that. And when we converted an old Kmart building, as I told you before, into a storage facility in a downtown area, we worked very closely with the city because it was zoned originally as retail, and we needed it to be zoned light industrial for self-storage. So we had to work with the city. And in this case, the city was thrilled because it was an abandoned building. It wasn't doing anything. It was an eyesore. And now we were able to turn it into something viable that will now pay taxes to the city. So that worked out very well for them. But you have to really understand what the government regulations and zoning are for the site. And you have to be able to talk to the government officials, the town officials, when you go down there doing your due diligence to see what they are willing to do and what they're not willing to do if you want to make changes to the property when you buy it.
Got it. So local relationships are very important.
Yes, and I would also add that it's good once you're there to be a good corporate citizen. So, participate in the Chamber of Commerce. Maybe sponsor a little league team or a fundraiser, or have people come to the site, which will help you, but also by sponsoring an event there. So you want to be a good corporate citizen, anyway, especially when you're buying from someone, as we are in this case now, that's been, it's owned it for 50 years. So this person has a lot of goodwill in the city. And the last thing we want to do is ruin that goodwill. We want to build on it.
Mhm. That makes sense. All right, Jeremy, jumping into the next question. I saw on your website that one of your core principles is to invest alongside your clients in every deal that you are buying. Why is that important to you?
Sure. So we think it's essential to lead by example. If we invest, we win or lose with our investors, and then our interests are aligned. We can call that skin in the game if you want. We will consider their interests and our interests the same and in alignment. If a sponsor is not doing that, then they're sort of saying, well, do as I say, don't do as I do. And we want to be very much do as I do. And we and our partners are going to invest typically at least 10% of the equity in each deal. That leaves plenty for our investors to make money with, but also shows that we have skin in the game and that we're going to win and lose with them as part of the LP.
All right, Jeremy, thank you for sharing that. My next question is, you've done a few deals in self-storage. What is the one deal that you're really proud of?
Well, let me take you through one deal that we're working on very briefly now that we're excited about. We're going to be buying a value add facility that needs a lot of work. It needs to replace a roof. We got to build out about 3,000 square feet of climate control. And it's from a mom and pop operator. We're going to be bringing in technology to make the place run more efficiently with online applications and payment. We're going to be updating the website and the advertising. We're going to be putting in place tenant insurance, and we're going to be increasing the rents to a market level. So we think that's a really substantial business value add plan. And if everything goes to forecast, we are forecasting that in about 5 years, we would sell at an equity multiple of 2.1x. So if you put $1 in, our forecast would show that you would get $2.10 back at the end of 5 years. And this deal will also be offering a 7% annual distribution because while it has all sorts of challenges, it's still actively cash flowing right now. So it's a good standard value add project that we're looking forward to executing.
That's great, Jeremy. So can you talk a little bit about the average hold time for someone that's invested in a syndication? What is a typical time horizon, and what's the optimal time to exit the deal?
So for value add properties, a lot of the hold times used to be as short as 2 years. People could flip out of them very quickly. With longer institutional class A type projects, maybe you don't want to flip out at all. You want to stay for 10 or 20 years. We tend to want the value add. And nowadays that's looking closer to 3 to 5 years. It's just taking a little bit longer with interest rates the way they are. The market is a lot less frothy than it used to be. And for sponsors looking to exit, they typically want to execute a business plan and then leave. So for the Kmart property that we had, we converted the empty building. We're going to be leasing it up. And once it's leased, we'll sell it to a company that may want to, in fact, use it for a long-term hold. But we're telling our investors now a 3 to 5 year period. And for some of the value add, what you might do is you might build out some of the units on a vacant property, but you're going to leave room for the next sponsor to build out the rest. So we sometimes call that leaving meat on the bone. So you're going to execute some of the business plan, but leave something for the next buyer. It's just, you've proved your concept, and then you would sell to them and they would continue apace.
Makes sense. And shifting a bit to the risk mitigation side of things, I know you covered a lot about how the syndications work, how the self-storage asset class works. Can you talk about some of the risk mitigation strategies you have in place to make sure your investors' capital is safeguarded?
Sure. The first thing is we always have an investor first mindset. And so we're going to scrupulously, very, very carefully underwrite the deals and the sponsor partners we work with. We're going to visit and do our own due diligence on the property. And we're going to really understand the deal. Just keep asking questions of our sponsor partner, of the broker, of the community to really understand it. And we're going to put protections into the offering documents as well, so that we're involved with the key decisions like refinancing or when to replace the property manager. And then we have provisions in there that, and this has never happened and hopefully never will, but if we need to remove a managing partner because they're not performing or they're guilty of fraud or something, then we will do that. But that hasn't happened yet, and hopefully it won't. But we do have those provisions in there to protect our investors. And we make sure that our investors are paid out before we take any profits, and we share profits in them, but first they get their monies back before anything else happens. And that, again, is part of our investor first mindset.
Got it, Jeremy. Looking into the future, what are some of the key trends you're seeing shaping the self-storage market?
First, I think no surprise, is just a technological transformation going on right now. There's online platforms, websites, people are using kiosks to search facilities, to rent online and manage their units. All that is now enabled from your desktop. From the owner's point of view, there's remote monitoring and security cameras and other types of AI and smart locks that enable people to, from the owner's side, also take advantage of the technology. Now, AI allows a lot of owners to be much more responsive to competitive pricing, so you can be on top of what's going on. It used to be that only the REITs had these complicated logarithms, but now that's passing down to anybody who's in tune with the market. And in terms of the market itself, we're seeing more climate control units that are coming on board because of global warming. We're seeing more boat and RV storage because people are buying boats and RVs. Certainly that was true during COVID. And then we're seeing a lot of demand for storage units from businesses. A plumbing supply contractor can put his entire business in a large unit, all his plumbing supplies, and then
Right.
put a desk in there and a light bulb, and he can go in and do his bookkeeping and so on, and then get his plumbing supplies out and take them to the next job the next day. And the last thing I'll just add is there is a growing presence of the REITs. They're becoming more aggressive in the primary and secondary markets, and we're seeing that competition is really pushing non-REIT players to up their game. And in a lot of ways, we think that's good.
That makes sense. And I know we're getting closer to the end of the podcast. So, uh, one of my last few questions, what are some of the three pieces of advice you have for someone who is looking to do a passive investment in a syndication or considering real estate syndication?
Sure. So, from a personal point of view, I would suggest to your listeners to develop their own sort of real estate investment plan, if you like. Decide to allocate a certain percentage of their net worth, their disposable, their investment income to real estate. We suggest excluding their home, and we suggest 15% as a number, and then figure out, divide that amount into chunks. So, and then invest it in different property types, in different geographies, and so on, to diversify your holdings. You're not going to buy one thing and then just, hold that. So you want to have some diversity in geography and property types. If you need income, make sure the project is providing regular distributions to you. If you don't want the income, consider properties that are, maybe in lease up mode, or if you are up for the risk, ground up construction, where there may be losses that you can take. So that's the first thing. The second thing is, very importantly, to work with sponsors that you can trust, that have a good track record, that underwrite conservatively, who are transparent and communicative, and send you quarterly updates and are available by phone and email when you need them. I pay attention to that scrupulously. And if an investor writes me on Christmas Day, I'm going to write him back on Christmas Day, because it's important to them. So people that are looking out for the investor first. And then the last piece of advice I'd give you is to be educated but patient. So read the offering materials, look at the sponsors' updates, read the news about interest rates and general economic conditions. The days of flipping out of properties in 18 months are over. You have to expect it's a 3 to 5 year business plan, and you do have to be patient but educated.
That's a very good point there, Jeremy. And to close this off, if someone is looking into self-storage and they want to get in touch with you, what's the best way to do that?
Sure. We have a website, and it has a lot of good educational material on self-storage in general. So while we'd love to have you invest with us, if you're just looking for general information about self-storage, there's a fair amount of good information that's out there. There's case studies and so on the website, scaffoldpartners.com, and then ways to reach out to me through that. And I also have a presence on LinkedIn. You can look at Scaffold Partners on LinkedIn and take a look that way.
Sounds good. Thank you very much, Jeremy. And I'll leave all your information in the description below. So you can reach out to Jeremy if you have any questions about self-storage or anything in general related to real estate syndication. Thank you again, everyone, for listening to the podcast. There are a lot more to come. So stay tuned and subscribe if you can.
Thanks. And I want to say thank you, Samarth, for asking the questions, to taking the time to really try to understand. And I thought it was a great dialogue today.
Thank you, Jeremy.
Thanks for tuning into today's episode. This podcast is where we dive into thought-provoking conversations on investing, real estate, business, and a wide range of topics that shape how we think and live. If you enjoyed the discussion, don't forget to subscribe so you never miss future episodes. Stay curious, stay engaged, and we will see you next time.